All right, we had to get on the bat phone to call Dr. Charest again. Dr. Charest, thanks for joining us. Beach day in Puerto Rico?
Absolutely,
All
as
right, well,
always.
I'm happy to hear that. It's 5 degrees in Omaha. Appreciate your time. All right, well, quickly, I wanted to hop right into something that we keep talking about that you are an expert on and I am learning. The financial landscape for these development stage biotechs. What's going on here? Because I hear a lot about IPOs, we hear a lot about off-market transactions. Give us an update, give us an overview. What are we seeing right now?
Yeah, so just a reminder for folks that may not be following the sector that closely. So the life sciences sector is the largest sort of source of capital markets transactions for existing public companies, right? So there are hundreds of pre-commercial stage biotechs that are funded solely through raising money and selling primary shares for as an existing public company to investors to fund operations. So everybody knows about IPOs. But Jonathan, a larger, volume of deals is actually what we call in the follow-on market, which are existing public companies that are, raising additional capital from investors to, really fund development. So maybe just to set the stage there, that's a little bit about
Yes.
the big landscape.
Let's bifurcate that really quick because IPOs, I got to be honest, I have not heard much about it. And I read the monthly commentary from LifeSci. I'm not seeing a lot of IPO activity. Why?
Yeah, so there was, record numbers of IPOs sort of the back half of 2020 and through 2021. That's cooled down considerably. And I would say that, our expectation is that you're going to see, a handful trickle through, but you're not going to see anywhere near the volume of IPOs, Jonathan, that we saw, sort of in sort of the peak boom times of, with zero cost of capital and everything else.
Right. It's funny. We saw all those IPOs at the beginning of the largest and deepest drawdown we've ever seen in the biotech sector. Is that coincidental, causal? I mean, I know it's hard to decide, but that's a really strange timing, isn't it?
I think it was, there was a component there, right? There was, if you go back to, the peak of the biotech index, which was, end of the first quarter, 2021, there was a lot of FOMO. There was a lot of hot money chasing valuations. There were, all these IPOs getting bid up, things were opening up 100% and ripping another 50%. I mean, it was, kind of like the dot-com had their era and had their day. Well, this was similar. Valuations were unsupported by fundamentals. So look, I mean, you expect to pull back. And actually, if you look at, those IPO classes today, Jonathan, the mean and median returns are decidedly negative for both, the 2021 and 2022 IPO classes. So there was, maybe a little too much exuberance. But I don't want to throw the baby out with the bathwater. So all those companies are still public, and a lot of them are going to come back to markets to do follow-ons at very different prices. And there's going to be some that are going to struggle to raise money, and some that are going to go out of business. But there's going to be a handful that are going to be very attractive for investors that are able to participate.
All right. Well, if you frame it that way, that they're going to be coming back for these follow-on financing, that must mean there's going to be this group of haves and there's going to be the group of desperate to keep running. How do we think through those two different class, so to speak, of follow-on financers there, financing?
Yeah, no, well said, Jonathan. So look, the fundamentals are going to drive the bifurcation, right? So companies that have differentiated data in large market opportunities that, meet critical unmet needs, they're going to be able to do follow-ons and raise, significant amounts of capital at reasonably attractive valuations. And that's what we've seen. There's been a number of companies that have raised multiple $100 million, kind of overnight follow-ons after announcing, fantastic data. Now, this is going to be a subset, right? So this is, maybe a handful of companies that have the, the best, most differentiated data are going to be able to do this. Let's look on the other side of the spectrum. There's also a couple companies recently that have announced that they're winding down operations, Jonathan. So these are, companies that were, valued as high as $2 billion market caps not more than a couple of years ago that are now essentially winding down operations and completely wiping out all equity value. And these had credible management teams, they had credible investor bases, right? These aren't these weren't fly-by-night operations. These are real companies that were working on real problems. And I think the message there is that for companies that perhaps don't have the most differentiated data, or are not funded through the next milestone, their cost of capital is going to be very high, and they need to be, I think, realistic and sober about deal terms that they're going to be able to get.
Yeah, there's a real danger there with that cost of capital very high for who's left holding the bag, or even for the amount of risk reward you're taking there. That could be interesting to say the least. I'm curious, like, again, not an expert on this follow-on financing, but where are they seeking follow-on financing from? Is it from ETFs? Is it from mutual funds? Is it all private funds? Like, what's that landscape really like?
Yeah, no, Jonathan, that's a good point. So there's only really a subset of investors that actively participate in these capital markets deals. So it actually takes a bit of work, right? You have to have relationships with the underwriters. They're typically done by, boutique investment bank, or some of the bulge brackets do them as well. There's a lot of different flavors. Some of them happen overnight. Some of them they'll do a confidentially marketed offering for a period of time. So you have to kind of be in the flow, connected with the management teams, connected with the underwriters, and really it's actively managed funds that are doing the heavy lifting, Jonathan. So an ETF, for example, really isn't structured to buy primary shares from a company. Those shares are the shares of the ETFs are created and redeemed by market makers, and they don't really have a good mechanism to put capital directly into an offering that's happening outside of regular market trading hours. So,
Sure.
as far as we can see, it's really the actively managed, kind of funds, mutual funds, or hedge funds and other traditional private investors that are doing all these deals, not the ETFs.
Yeah. Well, I'll tell you what, that was a 6-minute masterclass in this stuff. We could probably go on for a long time getting in the weeds, but let's not for the sake of time, but let's leave that as an opportunity in the future to go through these. So, Mark, thanks again for going over this and teaching us about the difference. We know how to find you. We're going to find you, and appreciate you making so much time for us again today. Appreciate it.
Thanks, Jonathan. And come down to see me in Puerto Rico sometime soon. We'll
I
warm you up.
should. Why am I here? Why am I in Nebraska in February when it's 4 degrees outside? What am I doing? I need to come down. It's always the beach day. All right. Thanks, Mark. We'll talk to you.
Have a great one. Bye-bye.